Nigeria has reportedly been attacked in northern Mali. Online video appears to show many bodies strewn across the desert sands.
Local people have been telling me, French news agency, that they believe Malian government soldiers were responsible, and they were accompanied by Russian mercenaries from the Wagner group who have been working with the military and government to tackle the Islamists in that area. They say they were responsible for the killing. Why they would attack a convoy of undocumented migrants heading towards Algeria is a mystery.
The BBC's David Bamford. A Chinese Navy helicopter is flying.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. Day after holiday. It's a holiday short week. The cookie gremlins showed up at my house over the weekend. Girl Scouts delivering their little cookies that my wife orders to intentionally throw me off my diet. But it's that time of the year. So anyway, interesting news over the weekend, of course. We've talked about, Richard, Danny, John Penn, Matt, all the guys here on the show have talked about Social Security. And of course, over the weekend, lots of headlines about the number of people that are collecting Social Security. 2025, a little bit later this year, will mark the 90th anniversary of the actual institution of Social Security when it was set up in 1935. And at that time, there was one person on Social Security. So when they first started it. So if you think about it, that means that if you were of 65 years of age in 1935, you're roughly around 150 right now. There are people actually still collecting Social Security that are older than 350 years old. So I don't know how they were still on Social Security and how old they were when they actually started collecting it, but considering that Social Security is only 90 years old, I think there's some questions about anybody over the age of 160 that is currently collecting Social Security probably needs to have somebody do a welfare check on them. I'm just saying. But if you actually just take the numbers of people that are over the age of about 140, and this is kind of the numbers. If you just assume say like a $1,600 a month kind of Social Security payment, kind of on average. Would you say that would be fair, John? About 1,600?
Yeah, about there, maybe a little over, but you're
Maybe
pretty
a little
close.
over, but and over time, right? It's gone up. So let's just say $1,600 a month. There's about $52 billion a month that's going out. That's almost $500 billion. That's over $500 billion a year in Social Security payments going out that may be questionable. I'm not saying they're fraudulent. I'm not saying anything like that, but they could. That's $500 billion a year. That could certainly shore up a lot of the underfunding status of Social Security and certainly make that a lot more solvent. So it'd be very interesting to kind of watch how this goes out. This is as this proceeds. This is going to be a kind of really interesting, but this could really solve a lot of problems. Potentially, we've talked about the risk that in 2025, Social Security is effectively bankrupt. In 2020, 2030, 2035, they're talking about 25% cuts to benefits. This could certainly have him. You can save $500 billion a year in payments. That would certainly go a long way into shoring up the funding solvency of Social Security, Medicaid, Medicare. So again, and if that's in Social Security, I'm sure it's going on in Medicare and Medicaid too. So just this could actually be a very good thing to help solve that problem. We've talked about that a lot in the past. This was one thing that we never talked about, was solving this issue. And of course, with what's happening with the Doge team right now, going through a lot of these payments, that could very well be a big benefactor for that. So that was kind of interesting news over the weekend. Other interesting news, of course, is we're about to have Nvidia earnings coming up. They're on the 26th of the month, so all eyes are going to start to kind of focus on Nvidia's earnings. Meta, by the way, has had a 20-day winning streak. That is the longest streak on record of any stock going back in history. So to go 20 days in a row is pretty incredible. That's every day you're up for 20 trading days straight, not one single down day in 20 days. Pretty incredible. Meta's been on a tear lately. And this is interesting considering that it's coming right after this whole DeepSeek crisis, et cetera. Everybody was all kind of worried about, oh, is AI over? And then here comes Meta going, here, hold my beer, and goes 20 days in a row on the upside. Stock is super overbought right now, but again, this is kind of things that go on. Of course, that's one of the big mega cap 7 stocks, and of course, that's been helping lift the market as well over the course of the last few weeks. But technology in general has been doing okay over the last couple of weeks, and that really kind of brings us up to talking about what you need to know before the bell this morning. Markets are doing just fine. So markets were closed on Monday. Nothing happened yesterday, if you were wondering. But on Friday, we closed right at all-time highs. Money flows continue to remain very positive, and of course, the kind of this positive action in the markets really last week, another winning week for the S&P, keeps that buy signal in place. So again, the markets are up about 5% for the year so far. Markets are doing just fine, really kind of coming out of the gate. We had a little bit of a sloppy start this year, right at the beginning. First 2 weeks of January were a little bit worrisome. But really, ever since the inauguration, markets have been doing very well despite headlines of DeepSeek and despite headlines of tariff concerns, all those type of issues, inflation concerns. Markets continuing just to really kind of power higher right now. Not a lot of concern really across the board, but it's not just U.S. stocks, and we're going to go through this in a minute just very quickly, but we have a lot of retail exuberance in the markets, and we're now starting to see correlations just kind of all go to one, whether it's gold or whether it's emerging markets or international markets or Bitcoin. The correlations have all moved to near 1, and this doesn't happen very often in the markets, but this is because there's too much money chasing too few assets, so it's lifting every asset class all at the same time. And in fact, if kind of looking at some other markets real quick, emerging markets have been doing very well, as also they're up sharply this year so far, having a very nice run. But be careful with this. Again, there's a lot of excitement. It's like this, this is the beginning. Emerging markets and international markets outperforming the S&P. That's where you need to be this year. We've had this call like every single year at the beginning of the year, and that's really not worked out well. In fact, if we kind of go back just over the last 5 years, emerging markets still have not broken out of their kind of long-term channel, and again, just have been trading sideways now for 5 years. And yeah, we have these intermittent blips of outperformance relative to the S&P, but really have not seen that really emerge more into anything else. So that was international markets. Sorry, emerging markets are the same way. Emerging markets remain doing very well at the beginning of this year, but we see that kind of at the beginning of every year. Everybody gets all excited, and then nothing really comes out of this. But emerging markets still much lower than they were back in 2021. So, again, just on a relative performance basis, yes, they're doing okay right now, but the economic dynamics certainly don't bode well for both emerging markets and industrialized international markets, which are very, very close to recessionary territory in a lot of fronts. But again, globally right now, there is money just chasing assets everywhere. So it's just lifting all asset prices at one time. The question is going to ultimately be, can international and emerging markets really start to play catch up with the U.S.? Certainly possible. But again, just be careful. We've seen these types of early year kind of moves of exuberance in markets. We get these high correlations that all exist at one time, and then things kind of break and fall apart after that. And we're going to touch on that a little bit more here in just a second, because we'll get into today's article. We're also going to talk about, should you invest in private equity? We're getting a lot of questions lately about private equity, private credit. Should you invest in it? Is it a good opportunity? Is it right for you? We'll get into that this morning as well with John Penn. So more of that coming up on the Real Investment Show in just a moment, but stick around. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And so welcome back to the show this morning. So today's article on the website is talking a little bit about retail exuberance. Again, this goes right along with what we were just talking about a second ago in the Before You Bell segment, because investors are chasing every asset class right now. We've talked about this a little bit in the past, and not only are they chasing it, but they're also leveraging up in a variety of manners. And something I haven't done in a while is go look at the margin debt levels on the New York Stock Exchange. And the last time I actually wrote an article about this was in 2019. And I wrote an article saying, hey, we're have all this exuberance in the markets. Everything is great. Margin, investors are taking on a lot of margin debt. And so we saw this rise in margin. Everybody's like, don't worry about it. It's no big deal, right? Margin debt is just, that's what makes the markets go up. And it's true. And there's a very important understanding about margin debt in general, which is it adds additional buying power to the market. So in other words, if you don't understand what margin is, it's a loan against your brokerage account. So you have $100,000 in your brokerage account. And let's say that you just own Apple as a good example. You have $100,000 worth of Apple stock. The brokerage firm will loan you 50% of that value to go buy other stuff with. So you can take your $100,000 and add another $50,000 of Apple to it, and now you got $150,000. So you got a loan outstanding for $50,000, you got $150,000 in stock. That percentage is really, really critical. And this is, while yes, it is true that margin debt is supportive of bull markets because it provides people more buying power, it also works in reverse. Because if the price of Apple falls, there's still that 50% of the value. So if Apple falls from $100,000 in your portfolio to, say, $80,000, well, now you can only have $40,000 worth of leverage, right? 50% of the 80, not 50% of the 100. So instead of having $150,000, you can only have $120,000 total value in your account, 80 plus 40. So all of a sudden, you've got to start selling assets. Well, here's the trick about margin debt is that selling those assets is not entirely at your discretion. You will get a call from the brokerage firm saying, hey, you need to either, add another $20,000 to your account to get the value back up to $100,000 to maintain this $50,000 margin, or we're going to sell some assets for you. And you generally have about 24 hours to get that funding put together. It's not like, oh, you got 30 days to send us money. It's like you need to deposit that today or we will be liquidating your account by the end of the bell. Well, the problem is this. So once I have 100,000, now I'm at 80, right? So let's say they've got to sell 10 to get me up to, my margin value again. Well, now they just sold assets, which means I have 70, which means I'm now at 35 on margin, which means I've got to sell more assets. And if anything happens with the price and it goes down in the middle time, this thing just starts fueling itself. And this is why we see people literally get wiped out. We saw this back in 2022 as a good example of this. There was a lot of margin debt going into 2022. And because of all the stimulus payments, because of all the speculative activity in the markets. And when the markets declined just 20% in 2022, we saw a lot of retail investors down 35, 40%, 50% in their portfolio. Some of it were much deeper than that because of the leverage in their account. And that margin started to work against them. So here's a chart of margin debt today, which is now at a record high. So we have gone right back full circle to where we were previously and have now run margin debt back up. Now, I want you to pay attention to that red line. And I'm going to show you another chart on this in a second. That red line is what's called free cash balances. This is the difference between your equity value, your loan, and how much cash you have left over, right? And now that number is inverted because it declines as obviously you have less free cash. But here's another chart of this, different way to look at it a bit. This is free cash balances versus the S&P. And what you'll notice here is that now again, the free cash balances are inverted. So, these big red mountains, that's negative free cash balances. That means that investors basically have no additional money to invest. They are 100% invested and leveraged in their accounts. That is at a record high. So we not only have investors long, they are super long and they're long on leverage. And not only are they long on leverage, they're long on leverage buying leveraged funds. So they're doubling their leverage. I'm got my $100,000 worth of 3-for-1 QQQ. I'm going to borrow 50% against that and buy more 3-for-1 QQQ. So not only am I leveraged, I'm super leveraged because of the leverage that I'm buying in my leveraged account.
It's a lot of leverage.
That's a lot of leverage.
And leverage isn't cheap. But just real quick, so if you're borrowing on margin, you've got interest that you're paying on that too, and it's just so if you're borrowing anywhere, just looking at kind of the national kind of average of what current margin interest rates are. I mean, if you're borrowing about $25,000, you're paying the brokerage firm about 12.5% just in margin interest.
Yep.
So you've got to overcome that
On
just
top
to
of
stay
it.
positive. So to get to a margin rate that's 8.25%, maybe 8-ish%, you need to be borrowing $1 million.
Correct.
Just think about that a little bit too.
Yeah.
Right.
And so as long as that, who cares though? Market's going up. I got 3-for-1 leverage in my Qs.
It's only 8%.
12.5%.
8%. Come on.
Yeah, it's nothing.
The market was
But
up 20 last year.
That's left pocket change.
8%. Come on.
So, but this is the important part. So again, and I'm going to wrap this up because we got other stuff to get into. But and all these charts and graphs, they're in the article today on the website. So again, just go to realinvestmentadvice.com. Just get today's article. But this is a chart of the S&P 500, emerging markets, and international markets. And I'm going to show you just 3 charts here real quick. But what you'll notice is there is a line at the bottom of this chart. If you're driving, don't try to look at this. I'll explain it to you. There is a very high correlation. The correlation between the S&P and emerging markets and international markets right now is 1. So in other words, they are all going up at the same time in the same facet, right? Now this is just a line chart of price, right? So this is not relative performance. Relative performance is vastly different. But the daily price changes of these assets have all now risen to 1. Now here's another chart for you just to kind of further explain this. This is the price of Bitcoin to the S&P, which has also got a correlation of 1. So in other words, they go up together, they go down together. Brent, one more. Last one, I promise you, Brent. This is the price of gold versus the price of the S&P. Its correlation is now 1. I ran this chart all the way back to 1975. And I've marked previous points in history where the correlation of gold to the S&P was 1, and that was typically the peak of gold whenever you got to a correlation 1. It's just simply that you're running, again, this just goes back to this basic fact that all assets are getting chased because I'm taking on leverage, I've got more buying power, and investors are just trying to find some place to put that capital. So they're just simply chasing I'm good, Brent. So they're just chasing any asset that's going up. So in other words, if it's going up, I throw money at it. Now, the important part about this is just simply the reality that when you have all correlations are at 1 and you have leverage applying to the market, you're going to get market deviations from long-term means. There is a very few points in history going back where you've had the market as deviated as it is now from its 24-month moving average, which is its long-term running moving average in the markets. These types of deviations only occur near major peaks of the markets. Now, it doesn't mean the markets are going to crash tomorrow. That's not what that means at all. But what it means is that we're on a freeway with our pedal to the metal, eyes closed, and we're just hoping there's no turns in the road ahead. As long as the road's straight, everything's fine. And we can continue to do this for a while longer. And the beautiful thing about leverage is that while we're heavily leveraged now, it can get even more leveraged before something eventually breaks. But the point is that we have all the catalyst in place for a very decent, you can bring this chart up for me, Brent. We have all the ingredients in place for a decent mean reverting event, technically because of these deviations that we have from long-term extremes. And again, these deviations right now, being fueled by leverage, being fueled by speculation, are typical near market peaks. The last time that we were this deviated was in the end of 2021, and yeah, 20% correction in 2022. It doesn't mean the world comes apart. It doesn't mean we're going to have a financial crisis, you lose 50% of your money. But it does suggest that at some point you're going to have a 10, 15, 20% correction. And if the risk The risk is that the market falls enough to trigger margin debt liquidations. As long as the market declines a little bit and not dramatically, where people have time to add more capital or to work out of their leverage, whatever it is, it's all fine. But if this market really cracks for some reason and you start triggering margin debt liquidations, again, margin debt works in reverse. It's great for fueling markets on the way up, but it really accelerates the sell-off on the way down because of the forced selling that occurs to cover margin debt. So anyway, that article's on the website. If you want to go take a gander at it, I've got all the charts and graphs in it for you. But it's just, this is kind of an early warning. Again, not being bearish, not suggesting that you need to go do anything major today. You don't need to go sell a bunch of assets. I'm not saying that at all. But again, it's just, we're in a car, pedal to the metal, hair on fire, driving down the freeway.
It's like on I-10 here in Houston.
Exactly. Got I Can't Drive 55 blaring at full blast. And it's all good, right? Just hope there's not a cop ahead somewhere. So, all right, quick break, come back. We're going to talk a little bit about private investing. Again, we're getting a lot of questions lately. And also, this is not surprising given where we are in the markets right now. Get a lot of questions of this, so we'll kind of get into a little bit of that conversation with John Penn right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
There's been lots of debates over shutting down the Department of Education, and that's really failed as a government agency to ensure that our children are getting a good education. Well, I have further proof it's probably a good idea that we try something different.
The Real Investment Show podcast.
I noticed this morning as I was getting ready for work, I looked at the milk carton and it said expiration date, February the 30th.
Same show, your schedule.
Just curious who was putting the expiration dates on the milk.
At realinvestmentadvice.com.
Apparently I have milk that either never expires.
It's the gift that keeps on giving.
Yeah.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So good morning, John.
Good morning.
How are you?
I'm good. How are you?
Excellent, excellent. So talk a little bit about private credit, private equity, private investing, private real estate, all these kind of things. We're getting a lot of questions on this lately. And again, it's not surprising. First of all, there were some changes about 8-9 years ago now. Time flies when you're having fun and just getting old. Where there were some changes to rules to allow more and more investors to get into private investments, kind of easing the rules a bit to do that, because typically you have to be an accredited investor, which means you got to have income of $250,000 a year, $350,000 married, and $1 million worth of net worth to qualify. And the thesis is that if you're making that much money or that you've got $1 million worth of net worth, that you are smart enough to understand the risk of kind of doing your own research and, buying private investments, right? Making private real estate, those type of things. That's the thesis anyway. But those rules have been around for a long time. So, people today, because of inflation and everything else, people have higher net worths that aren't really all that savvy about, doing the research, right? So they're easy people to pick on for, private investing scams. And they happen a lot, right? So, and again, one thing we've talked about before is, always ask the question if somebody comes up to you and says, "Hey, I've got this private real estate deal for you to fund to get into," and it's like, "Oh, it's going to return 20% a year, or whatever." Just always ask yourself, why am I so lucky, right? Because this, good deals are hard to find, and there are a lot of opportunities out there, but unless you know how to do the research and do the analysis, you can get yourself into trouble pretty quick.
You can. And that, going back to that definition of what an accredited investor is, you mentioned that $1 million of net worth. Mm-hmm. An important point there is that somebody's primary residence is not part of that $1 million. So that $1 million net worth excludes the value of your primary residence, right? So they're really the whole goal here with private investments, and really a private investment is an investment holding that doesn't trade publicly, right? So typically these have been reserved for folks that are higher net worth, and I guess in the eyes of the regulators out there, those that have a higher net worth are going to be a little bit more astute, maybe to have this as part of their overall net worth or overall portfolio,
right? And that's really kind of the key. So for instance, just for full clarity and transparency, right? We have launched a private equity fund for our high net worth clients, and it invests in private credit, it invests in private real estate. But as a good example, we have a third party due diligence company, we have auditors, we have the assets are held at Pershing through a prime custodian. So it's, we've done all the security backdrops kind of for this to ensure that the investments are quality, that, the custodial parameters provide good clarity, good transparency, the audits provide good transparency for the investors. We've done all that work for you, right? So you don't have to. We just say, hey, look, this is what this invest in, here's what the expected returns are expected to be, et cetera. But this is very, very important that if you're not doing something like that, if you're going through some guy just approaches you off the street and says, "Hey, I got this deal," can you do the research? Can you get transparency into the investment? Do you know where your money is going? Because private investments are very easy to scam people with. And,
yes.
and we see a lot of scams being done in the private space. Also, one other thing to be very aware of is lack of liquidity. One thing that as investors we've gotten very used to is that if we own just a portfolio of stocks, we can just go flip on the computer and see the value of it going up and down every second, blah, blah, blah. Private investments don't do that. They get repriced once a quarter. And if you want to sell them, like I want to sell this private investment, get out of it, you may not be able to do that. Some funds have the ability to, move in and out of them kind of on a quarterly basis or an annual basis. Some don't. And so you really have to understand what you're getting into, because you may invest into a piece of real estate as an example. And we saw this, there was a famous advisor, I won't mention any names, but he was on the radio for years and he was promoting this, they were promoting this REIT, and you had 3 buckets to put your money in. And you have one of your money in this one bucket, which was real estate. And it was always supposed to go public every year. This is going to go public and you're going to be able to get out of it. It never went public. Finally, it failed in 2008. And of course, the advisor got into a lot of trouble. You've got to be careful with that stuff because things happen. And so if you're locked up into one investment, you may not be able to get your money out of it.
Yeah. So that's, when you're in the beginning of the show this morning, you were talking a little bit about how, at least right now, it seems that all of the assets in the publicly traded markets, whether if it's, large company stocks, international markets, the emerging markets, Bitcoin, gold, they all seem to be more correlated now, right? And so sometimes the appeal with exploring private investments as a part of one's overall investment portfolio is that private investments are designed to be non-correlated to the publicly traded markets. Yep. And if it is a privately held investment, if I have limited partnership units in this, or if I am an investor in this privately held investment, and if things get squirrely out there from a market standpoint or an economic standpoint, I just can't log into my account and just sell my units or sell my ownership of that privately held investment. Because to your point, if some of those dollars that I contributed to that private investment are in actual real estate holdings, buildings, or land within that privately held investment, I just can't turn around. The fund isn't going to turn around and just sell that overnight. Right. So by design, a privately held investment, because it's typically valuated on a value, it's typically the valuation is updated, typically on a quarterly basis. It's designed to be less volatile overall. So that's kind of sometimes that is what leads to the interest in investments like this as part of an overall investment portfolio.
Yeah.
Right.
And look, and if you take a look at high net worth investors, we've talked about this before.
Yeah.
You take a look at a high net worth investor, some guy that's got 20, 30, 50 million, 100 million, whatever. They have about 20% in stocks. They have about 30% in bonds, about 30% in real estate, including, their kind of their own residences. And they have about 20% in private equity. And so it's again, kind of part of the diversification, because it does provide higher rates of return than what you can generate out of the market in many cases. But you are in for a ride to get those returns. And so you just have to understand, there's a good question in chat, like, how do you know if it's a scam? Well, again, there's simple questions to ask. Who's your auditor, right? Oh, we don't have an auditor. That's a good example. I remember back in probably around 2000, there was a group that was running around selling oil interest, and you could buy interest in their oil wells, and ask to go see them, right? If you're investing in a building, go see the building. Mm-hmm. Where's the building at? What's the address? I want to go see it. Look it up on Google Maps, and they were just selling people's pump jacks back in 2000. They go, like, that's our oil well. They were just picking a pump jack off the side of the road. Like, go, who has the rights to that, right? So again, if you're going to do it yourself, and it's fine, there's nothing wrong with it. I know a lot of investors who do their own private investing, and they're very, very good at it. They're very adept at it, but they know how to do their research. So again, if you're not willing to go drive out to the sites, and this is what we do in our fund. We talk to the fund managers, we talk to the investors, we talk to the developers, we go see the properties. We have a third-party company that flies out, does the due diligence on the company, on the managers, on they go put their hands on the real estate, whatever it is. And so you have all that due diligence in the background being done before the investment's ever made. And so if you can't do that, then that's a pretty, and they can't produce it, right? They can't say, well, here's our third-party due diligence, whatever it is. It's a pretty good idea that it may be a little bit more risk than you want to take.
Yeah, because at the end of the day, if you're investing in something that's privately held, you want to get an understanding of what does that investment own? What are the underlying investments in that particular privately held investment? So that way, if we do get into a more volatile or economically volatile environment, potentially how could those investments behave? What you want to avoid is putting your money into a privately held investment where your money might be in there for a lockup period of, who knows, 3 years, 5 years, 7 years, where that money is in those underlying investments, and that money will not be returned until there is some sort of liquidity event. Those investments are sold within the fund, and then that capital is returned to you. Well, what if you get into a situation where those underlying investments aren't performing, and maybe there isn't any return? You've got dead money for 3, 5, 7 years. So you have to have a good understanding of what is in that investment. So having all of those layers of that due diligence and having people out there that are boots on the ground, able to put their hands on what those underlying investments actually are. I mean, it's worth everything from just getting that information, right?
Yep. So anyway, there's just kind of look, and this kind of goes with any investment, not just private investments. Stocks, whatever it is. And again, it kind of goes back to what we talked about last week a little bit. If somebody's selling you something, right, they're going, oh, you need to own this, right? Then why are they selling it to you? Yeah. So if they're selling you gold saying, oh, you need to own gold, and they're selling it to you, why are you selling me your gold if it's such a good thing, right? So again, just always try to ask the question. And this is kind of the important thing, kind of the important part about everything is just always ask the questions, right? Ask the logical questions. If it's such a good deal, why am I so lucky to do this? And look, there's lots of great opportunities out there. And again, right now there's just tons of them. And again, there's good opportunities to make money with your capital. Just make sure you're doing it safely, or that you've got somebody working on your behalf that can help you do it safely. And that's kind of the important part, right? So just seek out counsel is always good advice. All right, quick break. We'll come back, get ready to wrap up the show. Got some other stuff to get into. Is the 60-40 portfolio dead, right? We'll talk about that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisor's Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. All right, talking about the 60-40 portfolio, is it dead, right? And, of course, this has been kind of the conversation over the last couple of years, obviously, because interest rates have gone up on treasuries. And, now people are going like, well, interest rates are never coming down again. And, we've been in these positions before historically. And again, going even back to 1900, hands down, without comparison, the best performing asset allocation on the planet is a 60-40 portfolio over long terms because it mitigates volatility to the downside. So owning stocks are great until you get into a really good bear market, and then you wind up, spending 15 years trying to get back to even. And that happens, kind of sequentially throughout history. So that's why 60-40 is, and we go through periods where markets are on fire. 60-40 portfolio was dead in the late 90s. Right, it's like, who wants to own 60-40 portfolio when you just own the NASDAQ, right?
Anything that was .com related.
Exactly.
Maybe they should have called it the 6040.com. That might have worked.
Would have worked. So again, we go through these periods, but when markets go through a mean reverting event, as we were talking about earlier this morning, you look at the amount of leverage we have, the amount of speculation in the markets. We have certainly the fuel necessary for a decent mean reverting event at some point. And when that occurs, that 60-40 portfolio will, show why that you want to own it. Now, but again, it's kind of the sentiment of the markets right now.
It is.
It's just the hype that kind of gets us here. So, I mean,
yeah, I think it's when you start seeing returns of, look at what the Standard & Poor's 500 index did last year in 2024. Look what it did in 2023, and. Folks, it's just amazing how it kind of comes back to the same theme, where as investors, we're all just so wired to compare our own returns to that of the market. But a lot of folks that I visit with, you want the returns of the market, but you really don't want the risk. So and so in the 60-40 in a year like 2024 or 2023, you're not going to get all the upside. Right. You just have to realize you're not going to get the full upside of the market because you don't have 100% of your portfolio in stocks. But in a year like 2022, you're not going to get the full downside either. So as an investor, you kind of have to think about, before you start investing any of your dollars, are you more concerned about the fear of missing out, or are you more concerned about just participating in the market or fear of loss? Well,
that's easier said than done, because investors generally fear the loss, right? But they still want all the upside. Right. So you can't have both. But this is always the challenge, right? It's overcoming those short-term emotional biases of I need to, this everything's going up, I'm getting left behind, I've got to get on the train. And generally by the time we do that, it's at a point where the train's about to pull into the next station, right?
Yeah. It's like when I start getting calls from folks who are like, I think I do want to become a little bit more aggressive. I think it's time. I want to become more aggressive. That's where my red flags go off a little bit and go, ooh, I wonder if we're getting a little bit closer to not a market correction, not the big one, but maybe just a little bit of a pullback here of some sort, right?
Yep. So, but again, this does bring up the question, though, is like, is the 60-40 a permanent fixture, right? Yeah. I mean, should you always be, 60-40 allocated? And in our view, that answer is no.
Yeah, I mean, the way we manage portfolios, and we have different allocation models, not just a 60-40. We have allocation models that have more stock exposure. We have allocation models that have more bond exposure, kind of across the spectrum, from to fit what is the the individual or family's, how much risk do they really need to take. Mm-hmm. But that 60-40, so any model that we use here, and I know we're talking about the 60-40, it's not static. And and Lance, what I appreciate about you and the investment team is you're forward looking with this to say, okay, well, if we get, depending upon what type of environments we get in, potentially how could this, quote unquote, 60% equity, 40% bond portfolio look, right? So let's fast forward a little bit here. And what if we get into a more challenging interest rate environment where rates are low again?
Right.
And
so it wouldn't be a challenging interest; it'd be a challenging market environment.
It'll be a challenging market environment, right? But let's say we get to a point where interest rates, who knows, are where yields on treasuries or bonds maybe aren't very attractive. So you've got roughly 35 or 40% of this portfolio that needs to be allocated potentially to securities that aren't really returning much from an interest rate standpoint.
Right.
So do we still, what does our 60-40, what could it potentially look like, or what are your thoughts around that?
So this just goes back, and I talked a little bit about this last week because we talked about our risk management model. In fact, I talked about it with Adam on Friday as well. But, like now, our portfolio, so our 60-40 model has the ability to go to 70% stocks, 30% bonds. It has that ability to overweight equities and underweight fixed income. And right now we're underweight fixed income, but we're target weight equities, so we have a little bit more cash than normal. But when the market begins to decline, then that equity portion of the portfolio can go all the way down to 15% exposure. So you can go from 60% stocks to 15% stocks, and then the rest is cash and fixed income. And so as you're going through the bear market, bonds should be performing well because yields will come down during a bear market, flight to safety, that type of thing. So yields come down, bond prices go up. You've got very little equity exposure at that point, and so your cash is just acting as an overall hedge, and you're picking up the income stream. Once you get down to the bottom of a bear market, so this goes back to, so think about 2008.
Yeah.
Good example. At that point, everybody was just assuming the market was over. Nothing's ever going to go up again. At that point, interest rates were so low, and even March 2020, when you're down to 0.5% on 10-year treasuries, they're not going to go down much more. So at that point, you don't want to really be kind of long debt in general, right? Because there's just no more return out of it. Interest rates are too low, and you've already kind of gotten all the gains out of it you're going to get. So that's where you start selling your debt. And now you can buy other stuff. Either at that point, if markets are really undervalued at that point, have really gotten blown out, then you're going to really overweight equity. So now your 60-40 model is 80% stocks. Your other rest of your portfolio is maybe busted convertibles, high yield debt at that point, because again, high yield debt will be completely blown out, and you'll be able to kind of sort through what corporations are going to survive. Back during the financial crisis, I was buying CIT bonds because CIT was expected to go bankrupt. They never did, and they actually went through a workout and then got issued out equity and issued out new debt, and we made a killing on that. When the British Petroleum Macondo well blew out in the Gulf, we were buying BP bonds because everybody assumed that BP was going out of business. Because of that, those bonds were heavily discounted over that risk, but they were making more in a quarter than what the total settlement was going to be. Yeah. Right. So there was no way they were going out of business. So when you get these kind of breaks in the market, you're going to start to find out which companies are being mispriced, and being able to pick up really, really cheap capital opportunities that are going to turn more into an equity investment, because as they start to return to normality, they'll be trading at 50, 60 cents on the dollars. They're going to very quickly, as markets recover, go back to 100 cents on the dollar. So you'll actually make more on the bond side on the recovery and just price than you will. So the portfolio structure will change from owning treasury debt to owning opportunity in fixed income that is more of an equity equivalent, if that makes sense.
That does. And I think, so I still see a lot of articles, and I've been getting a lot of questions too around the 60-40 and is it dead? I think kind of a static 60-40, because there are a lot of firms, and every firm has a different approach to this, but a lot of firms out there will say, okay, Lance, well, of the 60%, we'll always allocate 10% to the large cap growth market, U.S. We're going to put 10% in U.S. large company value. We'll always have 10% in small cap and 10% in mid, and the other 20% will always be in the international markets, right? And that's not us. Right. No. We don't feel like you got to own just every little bit and piece of every asset class all at once just to be quote unquote diversified. So any additional thoughts around that?
No. That's just, again, this is why we talk about relative performance. Yeah. And again, if I've got three assets to choose from, right? And just an example right now, everybody's really excited right now because emerging markets and international markets are doing great. Right? They're having a really good start to the year. Money flows are good. They're doing well, performing well. They're not outperforming the S&P that much. And over the last 15 years, you've just had massive underperformance in international and emerging markets. So until or unless there is a change to where you're seeing consistent outperformance over time and you're seeing a shift of economics and fundamentals out of the U.S. into other countries, which we don't see that yet, then you're not really getting paid to take that additional exposure risk on. So, I mean, we're better off just owning good quality companies that we can analyze, that we know, that pay a dividend, have strong track records and dividends. The economy in the U.S. is stronger than what we're seeing in other countries. So again, just you kind of stay with a winning horse for right now until you really begin to see that change. Right now, people are just jumping around chasing everything at the moment. That typically tends not to work out well. Right.
Yeah, and I think too. I think there's still a very much a buy and hold mentality out there, where if markets really start to break down more egregiously, I think a lot of firms. And again, every firm has their own approach to this, right or wrong. But I think a lot of firms will say, well, Lance, if you're in a 60-40, 60% equity, 40% bond portfolio, markets really start pulling down more egregiously. Well, the model says we need to keep you in 60%. We're not going to deviate from that. So I think it's great here that we've got some flexibility, or quite a bit of flexibility, where you guys can step in and reduce. You're not going to go to a 0% equity weighting, but you're going to bring exposure down just so you can help mitigate loss.
Yeah. And just real quick to answer a question in chat, yes, during a correction, value stocks will far outperform growth in that environment, because over the last few years, value has not really participated with the market. So there is value in value. And money will rotate towards safety and fundamentals during a market correction. So yes, value should it doesn't mean necessarily they'll go up, but they will definitely not go down as much as growth-oriented companies in that environment. All right, that wraps up the show for today. Thanks so much for joining us. Be back tomorrow with Danny Ratliff and more of the Real Investment Show tomorrow. Get by the website. Our latest article is out on retail exuberance on the website, realinvestmentadvice.com, along with our daily market commentary. See you back here tomorrow.